Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, we have a jam-packed show today.
I know. We've got the aftermath of the jobs report, and we've got China, and this is before Chinese markets reopen.
I know, a lot to get to. So let's get to the biggest stories right now in the more than $13 trillion global ETF industry, and investors dialing back their Fed rate cut bets, sending the U.S. 10-year yield to 4%. For the first time since August. That's after that recent blowout U.S. jobs report.
As the world-leading rally in Chinese stocks drives record inflows into ETFs, we take a look at a new fund tracking a handful of China's biggest tech names. We speak to Roundhill CEO Dave Mazza.
And we'll also take a look at a suite of new ETFs that are listing today on the Cboe with its global head of ETP listings, Rob Marrocco. As always, before we get there, Bloomberg Intelligence is Eric Balchunas. Jeez Louise. He's here with us now. He's looking at the flows. I've never said that wrong.
You haven't. I'll give you that. So you get a freebie.
All right.
Yeah.
All right.
Thank you, Katie and Scarlett. Look, Katie talked about the Fed, right? The Fed's pretty big in here, and I'll explain. Well, first of all, IBV and VU at the top of the flows, that's sort of the retail bid, right? The Vanguard bid that's alive and well. But more in a minute about how there's going to be some traders that have actually sold out. But check out these other tickers. You probably don't recognize FXI, KWEB, and Yin, but those are 3 China ETFs. You never see them this high. But the Chinese government bought a ton of ETFs in a QE strategy to get the stock market moving, 90 billion to be exact, and it finally worked. Stocks are going crazy over there, and foreign investors are now piling in through these ETFs. Let's look at the outflows here, and you can see some of the trading crowd back in the U.S. when it comes to SPY and the Qs leaving. I think maybe that next rate cut isn't coming so soon, and so people are taking some profits. You know, we'll see how this goes, but up until this week, flows into equity ETFs have been pretty good. Now, let's look a little more of those China ETFs. When you see 3 in the top 7, clearly there's something going on. Well, let's look at China ETFs as a whole category, and this is the monthly flows. So October, already 1 week old, right? And we're at 5.3 billion. If that month ended right now, it would be the biggest month on record for China ETF flows. Right, Katie? So listen, QE is very popular, and now everybody's trying to rush and sort of ride that QE wave over in China.
Absolutely. Eric, thank you. And joining this conversation now, I'm pleased to say we have Kristy Akullian. She is head of iShares investment strategy over at BlackRock. And of course, as Eric mentioned, you've just seen this massive rush into China ETFs, including into iShares listed products such as FXI. I want to hear about the context here, because we've seen this before, of course. In 2022, for example, you just saw so many people buying big into China only to be disappointed. When you think about what we're seeing this time around and the big flows following that, what's the BlackRock take?
Yeah, and thanks for having me. It's great to be here, Katie. I think Eric got this exactly on the head. We've seen, flows pile into some of these China ETFs. I think the starting point here really matters. And what we saw across a variety of investor positioning data is that investors have been very underweight China exposure. If you think about where some of the flows have gone in emerging markets recently, it's really been into EMXC, so China, emerging markets ex-China. I think that what we're seeing now is a reflection of that modular approach to portfolio construction working. So investors are using FXI, as you mentioned, in a really big way to just adjust those weights. So I think on the back of some of this, the stimulus that we saw both on the monetary and the fiscal side, we saw FXI had its largest ever trading day for the ETF. It had its largest ever flow day last week. And really interesting, we've seen a really large jump in ETF options as well. So FXI options had a record trading day as well. There were 9 times as more calls as there were puts. So you can see that investors want to get exposure to this. They don't want to miss some of the upside. I think a lot of that is still a reflection of them addressing some of that underweight and using ETFs as a really tactical vehicle to do so.
Okay, so that's a China story, certainly a bit of a reflation trade there. But I also want to talk about what's going on in the U.S., because on Friday we had this blowout jobs report that Katie mentioned. And your base case for this fall was for U.S. growth to gradually slow but remain positive. How much does that blowout jobs report challenge that outlook, perhaps, and build a case to be more aggressive on cyclical companies like maybe small caps?
Yeah, so I think that at the high level, we've been relatively risk on, and this only encourages that. What we did expect and what we have seen is a fair amount of volatility in the fall. So I think that we're kind of balancing those two things as expecting volatility, but still seeing this macro environment as being really strong for risk assets. So we're still leaning into equities in a pretty significant way. I think we see the opportunity of being really flexible and really dynamic in equity allocations. You asked a little bit about the rotation trade. I think it's interesting to note that since the mid-year point of this year, we've seen utilities as the strongest performing sectors and not technology like we've seen over the last most of the year. So, we've really seen this broadening out trade happen. We think that now is a moment to think about moving from mega caps to large caps, not from large caps to small caps. And I think that another way that you can approach this is that it's it's a time to think a little bit more about a balanced mix between value and growth. So we've seen growth perform really strongly. We've also seen investors be really under-allocated to value relative to benchmark as a result. So we see opportunity in something like the BlackRock Large Cap Value Fund, which is an active managed strategy that really I think investors are gravitating to just to address that growth balance mix within their portfolio.
And speaking of that, one ticker you have in here is GARP. Now, a lot of the folks on my team love this ETF. They love this concept, growth at a reasonable price. Explain what this does. I mean, it has outperformed the S&P by 9 percentage points this year. So you think it can keep going beyond that?
Yeah, so we love this ticker as well. I think it's a relatively new one that we're talking about in this particular environment. You can think of this as sitting at the intersection of sort of growth and value as well. So we're looking for stocks that do still have value characteristics. I think really importantly, we're also still focused on quality. I think between growth, adding, and just having a little bit more mindfulness towards valuations, that's what we think can continue to do well in kind of the year ahead.
And talk to us a little bit about fixed income. Of course, we know that Bank, for example, Rick Reeder's Bank gets a lot of attention. But, I mean, over at iShares, you guys really cover the whole gamut of fixed income funds. Where are you seeing the interest now, of course, as the Fed started its rate cutting cycle? I know that there's some questions about where it goes from here, but at least we got the first one.
Yeah, absolutely. So our view has been that we think that there's been too many cuts priced into the market, at least in the near term. So, the way we're thinking about fixed income now and the way we think about it in a cutting cycle in general is that timing and curve positioning are really key. So in terms of timing, the earlier, the better in a cutting cycle. So we are still seeing flows move into fixed income, even though we've seen some volatility in the interest rate space. And then curve positioning as well. We have and continue to like the belly of the curve. I think of it as kind of the 3 to 7 year point. So IEI would be reflective of that in the U.S. Treasury space if you're looking for a ticker. But that's where we see the best balance of risk reward. So yes, we still see a lot of opportunity in fixed income. We don't think that recession is the base case, but we do see advantage in holding fixed income there as a diversifier, again, because we've seen stock-bond correlation go back to negative as well.
Well, Kristy, taking a look at the flows, plenty of investors agree with you. Great to catch up with you. Again, that, of course, is Kristy Akullian of BlackRock. Now, coming up, speaking of massive inflows, just as we see them into Chinese ETFs, a new fund launches to capture the performance of China's dragon companies. We'll speak to Dave Mazza of Roundhill next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And of course, we're talking about China. You have 4 of the biggest U.S.-listed Chinese ETFs behind me. Their combined flows, and as you can see, they have just been off the charts, almost literally, because following that big package of stimulus that we got from the Chinese government about 2 weeks ago, investors, of course, have been taking notice. And it's interesting, Scarlett, because you take a look at the past year, not a lot going on. But of course, Beijing speaks. Investors have been listening.
Absolutely. I like the way you put it, off the charts, because it makes everything else up until that point look like it doesn't exist. There's also a new China-themed ETF launching today, the Roundhill China Dragons ETF. Ticker is DRAG. Joining us now is Dave Mazza. He is CEO of Roundhill Investments. Dave, DRAG offers focused exposure to China's big tech companies. We're talking anywhere from 5 to 10 names. It's like the Chinese version of the Mag 7. What's the criteria for companies to make it into this fund?
Yeah, no, you're absolutely right. So the idea behind the Roundhill China Dragons ETF is to capture the same zeitgeist and type of companies that the Magnificent Seven represent in the US, but for the Chinese equity market. And so we're really looking for the largest companies, the most liquid companies, but not just that. Those are at the forefront of innovation that are growing their revenue, that are really driving what the future will look like in today's world. And so that's why what we have today in the portfolio is 9 stocks. So names like PDD Holdings, Alibaba, Meituan, that are representing what's exactly exciting about the Chinese economy today and in the future.
Now, China has had a lot of bad news over the past couple of years. It seems like when I gather from talking to people that a lot of people don't buy this rally. I know it's QE induced, and that's generally good, but it seems more like a sugar high than the real deal. What do you say to somebody who comes back with you with that?
Well, look, it's a valid point. We've seen fits and starts over the years of the Chinese equity market recovery. Most recently, there was one in February that ended up going nowhere. What's different this time around, though, and I know those are dangerous words in finance, is the size of this bazooka that's being fired by the PBOC. They're identifying the issues that exist within the Chinese economy, particularly in the banking and financial sector, and trying to address those. In addition, tomorrow, Tuesday, October 8th, there is a potential for more stimulus, a further announcement made by the Chinese authorities that could be focusing on some of the other issues that exist with China, particularly on the fiscal and structural side. So I would say we finally have the bazooka-sized stimulus that some folks have been looking for, coupled with very, very inexpensive valuations that makes it hard to ignore China, second largest economy in the world, and the second largest equity market.
And Dave, my colleague Rebecca Sin has been covering this for months. The Chinese national team has poured $90 billion, and guess what they bought to stimulate the market?
Tell
ETFs.
Us. Wow.
Yes, I know. Shocker, right? Well, just like the Fed did. The Fed bought bond ETFs. China's buying equity ETFs. How much difference does that make, and how pointed are they being in which ETFs they buy?
Well, I think you're absolutely right. So they're following a playbook that we saw used by the Federal Reserve most recently during the COVID period, where they're buying bond ETFs. And at this point, from what the reports that we're seeing, is that they're looking to identify broad-based exposure. Part of the stimulus measures is actually a facility that financial institutions can use to buy stocks and bonds, and included in that is ETFs. So there is this large bid in the market. There's also been reports, and we've seen it on social media, folks lined up to open brokerage accounts. The local Chinese equity market has been closed for a week, opening tomorrow, and there's actually, I think, potential for even more opportunities to come because, again, of the inexpensive valuations, and especially for the China Dragon names, actually positive sales growth, earnings growth, and net income growth.
Yeah, it's fascinating, of course. Another stamp of approval for the ETF wrapper, this time coming from China. Coming back to drag, though, it's interesting. You take a look at the construction. This is an equal weighted basket. Dave, why go with equal weight versus market weight, for example?
Well, one of the interesting things is when you're taking a more concentrated position, a more targeted position, like we've seen with the Magnificent Seven, our MAGS ETF in the US, it actually can be beneficial to have that equal weighting. So it forces this precision in the portfolio actually to sell winners and buy the losers on a quarterly basis. So we applied that same methodology here to drag. So we gain that exposure to what we've identified today as the 9 China Dragons, but ensure that we're not having one of them drive outsized returns, both positively or negatively in the portfolio.
Let me just correct a mistake I made earlier, which is that drag actually launched last week. But your timing, Dave, is impeccable because in the week leading up to National Day and Golden Week, as Katie mentioned, the government unfurled all these stimulus measures, fiscal, monetary, and you're saying that there's more to come as well. When did this process of coming up with this China-focused ETF begin, and how long did it take to really dot all the I's and cross all the T's?
So we actually first filed for this ETF back in May, and the impetus there was that we saw the investor interest that we have in our Magnificent Seven ETF, which is over $750 million, that was launched in recent past. And what's interesting is that we said, hey, if we take a look at the equity markets, there's a lot of similarities between the Chinese equity market and the U.S. equity market. And we saw a product gap that was missing for precise exposure for Chinese equities. Of course, we could not predict that our launch date would coincide with some of the largest stimulus package ever announced in the Chinese economy, let alone any economy around the globe. So there's some luck involved with that. But really, the process to do so had nothing to do with the stimulus that was recently announced.
Okay. We were wondering whether maybe you saw it coming and rushed it out the door, but it sounds like you hit it really well in terms of timing. Dave, thank you so much for joining us. Dave Mazza is with Roundhill. Now, still ahead, Cboe's Rob Marrocco, its global head of ETP listings, will be joining us next on new listings on that exchange. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, Scarlett, we have a first-of-its-kind ETF. These literally launched today, and they're yet to be on the market. Okay, what is it? Okay, this is the Shell PLC ADRhedged. Okay, that's a mouthful, but it's pretty simple what it does. If you're in the U.S. and you want to own a foreign stock, you have to buy the ADR. Right? That's the American Depository Receipt. That comes with a U.S. exchange rate with the foreign currency. This says, hey, why don't we make it like you're literally in the country buying the stock as a local would, so no currency impact. So they hold the stock plus the currency forward to neutralize the currency part. 19 basis points is the fee. To me, that's pretty cheap considering these are going to be used for trading tools. So that's a cheap price tag for this. Very new, not even 1 million in it yet, but it just launched today. Let's look at what it holds, and this will be a short story. It only holds the ADR. So it's going to hold this, but again, use the forward to cancel out the currency. This is similar to currency hedged ETFs, but they do that with whole indexes. Let's look at the return of Shell based in London and Shell ADR. So you can see if you bought Shell and you're in the UK, you had 97% gains over the past 10 years. If you bought the ADR, you had 52%. Why? Well, this is the currency, right? Strong dollar, right? So here, this is going to let you hedge out the currency and get the LN return as if you were a local investor. So, Katie, whole new concept here. I'm sure we're going to see dozens of these ETFs coming out over the next couple of years.
All right, Eric, thank you. And joining us from London to talk about this ETF is Rob Marrocco. He is global head of ETP listings over at Cboe. So this is an interesting one. Of course, these products are sponsored by Presidian Investments. Cboe is the listing exchange. These are first of their kinds. Talk to us about the significance for Cboe that you are the listing venue.
Absolutely, and thanks again for having me back, Katie. ADRhedged is the next generation ADR, so to speak. They're utilizing the ETF wrapper, the technology that affords, and allowing an innovation on a 100-plus-year-old product that has been in the market in the U.S. for years. But this is not a first for Cboe. Cboe actually supported products of a similar nature in Canada, listed on Cboe Canada, our Canadian depository receipts. Those were originally rolled out in 2021 and now consist of 65 different names, U.S. names that are available in Canada, in Canadian dollars with a currency hedge. So this is building on the support that Cboe has offered in terms of utilizing different product structures and allowing for innovation in local currencies in local countries. So the launch today, we're super excited. These are the first of the 3 of the first tranche of products that have been filed for. 17 have been filed for from Presidian, where Presidian, again, as you mentioned, is the issuer. CIBC is providing the currency hedge, and just, again, enabling U.S. investors to own the company and not the currency.
Got it. All right. Well, Rob, you mentioned this is the first of a series of them. There's going to be 14 additional ADRHs in short order. How do you and Presidian go about deciding which foreign companies to focus on?
Well, the issuer definitely at the end of the day is ultimately in control which products, but a lot of that comes from the client demand, what they hear from clients. When you look at the list that's been published of the first 17 that have been filed for, they are very large, extremely liquid U.S. ADRs. So it's the most logical place to begin to work on the U.S. ADR market, which has over $1 trillion in U.S. ADRs today.
And Rob, who are these for? So I don't see a bunch of RIAs needing this, but it seems like maybe direct retail who likes to just trade stocks, and also potentially institutions who do really appreciate the currency risk that is taken when you invest overseas. But who do you see as the target market?
Well, I think when we look at these products today, and understanding, to your point, Eric, as you just did a great job explaining at the top of the segment, a lot of folks don't realize that when they're buying the ADR, they're buying it in US dollars, that they have that embedded currency risk, and what that potential risk and volatility that potentially holds along with that position. So I do see that absolutely more sophisticated investors today may be applying that overlay onto their product. This just allows easier access. Just as the ADR had originally allowed for easier access to that international company, this takes it that step forward and allows them to truly own it in the local currency, in the US dollar.
I want to talk about what this means for Cboe a little bit more, because, of course, you think about the listing venues for ETFs. You have the New York Stock Exchange, you have NASDAQ, and you have, of course, Cboe. When you think about sort of the pitch that you make to issuers about why you should list with us versus maybe any of the other ones, I mean, does this help serve that purpose to say, hey, look, we're doing really innovative things here?
I think that's exactly it, Katie. And what sets us apart is the ability to import and export best practices from the 5 stock exchanges that we're operating globally and supporting ETFs. So this is a perfect example where we've had a 3-year working relationship with CIBC, helping list those products and get those products to market in Canada. As I mentioned, they now have 65 CDRs available. They're all listed exclusively on Cboe. And this here in the U.S., because of that experience, because of the know-how, and we look at the fact that we have been the destination for innovation as of late. When we look at digital asset ETFs, when we look at the buffered and defined outcome products, really, again, being there to support the issuer, their investment strategy, and utilizing the benefits of the ETF from an innovation standpoint.
All right, Rob, great to speak with you again. That, of course, is Rob Marrocco of Cboe, making the good point that all of the oh God, I can't even talk. All the important fun products have been going.
With the mispronunciations. I like it.
Forgot who you are, forgot how to say words. Anyway, you can read about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. That has an editor, so no typos there. But that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett and Eric, and this is Bloomberg.